Alright guys, I'm going to be breaking down ICT's Silver Bullet model in the simplest way possible. Now, many people massively overcomplicate this model, but all it consists of is just a liquidity sweep, a market structure shift, and a fair value gap. And it only applies from 10 a.m. to 11 a.m. Eastern Standard Time. So if you catch your trade outside of that 1 hour time window, then it is simply not the Silver Bullet. So in this video, I'm going to be showing you guys the exact time window that I want you guys to be trading in. I'm going to show you guys what a liquidity sweep must look like. I'm going to show you guys what a real market structure shift with a displacement will look like on this model, and what a true fair value gap looks like for the perfect entry. So no fluff, none of that confusing jargon garbage, just the model explained properly. Okay, now here's the three markets that I do recommend you guys trade using the Silver Bullet. These are the cleanest price action markets when using the Silver Bullet and any ICT concepts in general. So if you're a Forex trader, Euro USD, GBP USD, USD CAD, I hate to break it to you, but this video is not for you. Okay, so number one, again, it needs to be within this 60-minute time window from 10 a.m. to 11 a.m. And I'll put an exclamation mark in there because it needs to be in Eastern Standard Time. If it's not in Eastern Standard Time, then you're going to get your time zone completely wrong. So all you need to do to fix that on TradingView is click bottom right where it says time zone, and then go to UTC -5, which is New York. Just tap on that and then you are good to go. Number two, we need to see a sweep on the higher time frame, or price must mitigate a higher time frame PD area. Think higher time frame bearish order blocks, higher time frame bullish fair value gaps, higher time frame new week opening gap. Even better if it does both. For example, the market sweeps London low and will also mitigate a 4-hour buy side imbalance, sell side inefficiency, which is essentially a bullish fair value gap. That is where you'll typically find the best Silver Bullet. Then number three, we simply need to see a market structure shift and a displacement. So it's simply just a short-term high, just a 3-candle structure, broken to the upside or to the downside, depending on the trade direction, with a sharp displacement. We need to see speed. Then lastly, to complete the Silver Bullet model, we just need to see a fair value gap. And as soon as price prints that fair value gap after the market structure shift, you're just simply waiting for the retrace into the gap, and that's where you're going to take your refined entry. So here's a couple examples, one bearish example and a bullish example. So starting with the bearish example, this is just a higher time frame sweep. So price is trading in a uptrend, higher highs, higher lows. We sweep higher time frame buy side liquidity. We get a sharp displacement to the downside with speed. Real important. Must be breaking a short-term low. Even better, an intermediate term low. And then we're just simply waiting for the fair value gap. If there's no fair value gap, then it's not a true Silver Bullet. But then as soon as price retraces into the gap, you're going to go short right there at the low. Stop loss is going to be above the external range high that actually swept the higher time frame liquidity, and then you're just targeting the opposing liquidity. So for bearish example, price sweeps buy side, you want to be targeting sell side liquidity. Okay, so the bullish example, so initially price is in a downtrend, making lower highs and lower lows. Then eventually we get below a key level, making a higher time frame sweep on sell side liquidity. It could be London lows, Asia lows. Any higher time frame sweep could be on the 50-minute, the 1 hour time frame, the 4-hour time frame. But think the higher the time frame, the more significant move that you will catch on the lower time frames. So for example, if you get a 50-minute sweep, it's not really going to be as much movement in terms of displacement from that level as it would be from a daily swing high. Again, that's not to say a 50-minute sell side liquidity sweep isn't valid. It totally is fine. But what I'm trying to say is the higher the time frame for the sweep, the more displacement and the more room price has to move to the upside for a bullish example. So again, lower highs and lower lows, we take out the higher time frame sweep, taking out sell stops or sell side liquidity. We want to see a sharp bullish displacement to the upside, big green candles or whatever color candles is on your chart. Breaking a swing high, just a 3-candle structure to the upside, and then we just need to see the fair value gap entry. If there's no fair value gap, again, there is no trade. It's not a true Silver Bullet. But if there is a fair value gap, you're simply waiting for the retrace into the fair value gap. You're going long at the high. You're not trying to get fancy and going long in the midpoint of the gap, just simply going long at the high of the gap. Stop loss is going to be at the external range low that swept the higher time frame liquidity, and then you're just simply targeting opposing liquidity. So for a bullish example, price sweeps sell side liquidity, you want to be targeting buy side liquidity, which is the opposing liquidity of the dealing range. Okay, so now that you guys understand the framework, I'm just going to show you guys a couple of chart examples. So starting with the bearish chart example, we can see that on the 4-hour chart, price has just been in an uptrend, takes out a higher time frame level. This is even a level on the daily chart as well. So again, just like I was saying before in the framework examples, that whenever you get a daily sweep on liquidity on an all daily swing high or an all daily swing low, that's where you'll typically find big displacements, and that's where you'll catch the highest risk to reward ratio moves. So you can see that price is inside the silver bullet hour from 10 a.m. to 11 a.m. and you can see it's just making higher highs and higher lows until we take out this buy side. Then we put in this swing low right here. Notice the displacement. As soon as price trades above this high, quickly moves to the downside with a sharp displacement. That's exactly what you guys want to see. So number one, we're inside of that 10 a.m. to 11 a.m. silver bullet hour. Number two, we've swept higher time frame buy side liquidity. Number three, we've got the displacement with the market structure shift. And number four, we also have the ICT bearish fair value gap because we're looking for shorts. So as soon as price retraces into the bearish fair value gap, that is exactly where you want to be taking your short. Stops are going to be at the external range high of the sweep, and then you're just simply going to be targeting the opposing side of liquidity, which would be sell side liquidity. Example, price takes out buy side liquidity, you want to be targeting sell side liquidity. So again, this is what sell side liquidity looks like. Just a swing low, a more prominent swing low on the 1 minute chart, or you could use this low, just whatever suits your preferred risk to reward, and whether you want higher profits on the trade or you're comfy just taking low hanging fruit objectives again. So the higher the risk to reward that you guys want to chase in terms of profits, for example, this is a 4 risk to reward ratio. Now this will be like a 30 to 40% win rate if you're consistently trying to target 4. But if you're just trying to go for low hanging fruit, for example, 1.5 or 1 to 2 risk to reward, this model, what I'm showing you guys here, leans around 60 to a 65% win rate with those specific risk to rewards. Just like I'm saying, the higher the risk to reward, the lower the win rate. But let's say for in this example, you target this sell side liquidity, and you can see on the daily chart, you can clearly aim for higher risk to reward objectives, and then ultimately that 4R objective would have been smashed, all because we've taken out such a clear important high on the daily chart. Now this is a 1 minute chart, guys. This is the chart that I want you guys to be trading on. If you don't have the fair value gap on the 1 minute, you need to be scanning through the 2 minute, the 3 minute, the 4 minute, and at maximum the 5 minute. You don't want to be going any higher than the 5 minute. So yeah, you can just clearly see as soon as price sweeps out such a higher time frame price point and liquidity on the daily time frame, it's going to have such a high impact on the lower time frame respective price action. So you can clearly see how price action holds bearish after the silver model plays out. Okay, so again, here's now a bullish example. Again, 10 a.m. to 11 a.m. Eastern Standard Time, guys. Remember, New York time. Okay, so now that we're inside of the time window, step number one, you want to see that sweep on liquidity. Since this is a bullish example, you're looking for a sweep on sell stops. So there's number one checked off the list for liquidity sweep. Number two, you're just looking for a sharp displacement with speed to the upside. That's exactly what we'll get right here. And then last but not least, to confirm the full silver bullet model, you would just want to see a bullish fair value gap, and you can see how price prints the bullish fair value gap. You're looking for the retest. That is exactly where you want to be going along. As soon as price retests it there, stops can be at the external range low where the liquidity was swept, or it can be below candle number 1 of the fair value gap, or candle number 2 of the fair value gap, because again, the bullish fair value gap and the bearish fair value gap is just a 3 candle formation. You've got candle number 1's wick high for a bullish fair value gap, and candle number 3's wick low, and the fair value gap is just the gap between candle number 1's wick high and candle number 3's wick low. So in the bullish examples, you can put your stop loss at candle number 1 or candle number 2, or if you want to be extra conservative and safe, just put it at the external range low. Again, if you're putting your stop loss all the way down here at the external range low, your win rate will be slightly higher because price can easily wick down below candle number 2 or even candle number 1 and then deliver the move in some cases. So again, it's just whatever your guys' risk to reward favored ratio is, whether it's a 1R, 2R, 3R. Just know that the higher the risk to reward that you guys are aiming for, typically what you'll see is it's going to be a lower win rate. Okay, so let's say for in this example, you're just putting your stop loss at the external range low and you're going to be targeting opposing liquidity, so buy side liquidity. You can see for in this example, TP unfortunately did not get hit. Now, I'm not one of those mentors who are going to show you chart examples of only winning trades. Obviously, it doesn't matter what strategy you trade, whether it's the silver bullet, the unicorn model, optimal trade entry, you are going to have break evens and you are going to have losses. So that's exactly why I'm showing you guys a break even trade in this scenario, because I'm not showing you guys this strategy for it to be 100% win rate. I'm not promising you guys anything like that. Obviously, you're going to have losses trading this model, but what's most important is that in any model that you trade, you are going to have an edge if you do stick to and refine the model with proper risk management. But yeah, guys, obviously price gets close to TP. By now, you guys will be break even on the trade, and then price comes down and stops you out at break even. So if you guys are unsure of when and where to trail your stop loss to, here's a quick little guide just to show you guys. So what you do is you get your Fibonacci and you get it from your entry point to your take profit point. And as soon as price gets to 50% of that range, you guys want to be trailing your stops, or trimming your stops, should I say, by 25%. So this is the 25% extension on the fib. You guys just want to be trailing your stops there. As soon as it gets to 75% from your entry to TP, that's when you guys want to be going break even. And then as soon as price gets 75% towards TP, you get stopped out at break even. And I trade this exact model every single day in the markets from Monday through Friday live with my Discord teams. So if you guys want to copy my trades, take the exact same trades as me, same stop loss, same take profit, then if that's something that you are interested in, the link is in the description of the video. Also, if you're still failing to get payouts, you're still failing to pass funded accounts, and you want a fast track method to pass funded accounts and get payouts, then I do run a one-to-one mentorship. So essentially what it is, it's just a 4-week program. You get 1 call per week, around 60 to 90 minutes long on a Zoom call. And in that Zoom call, I'm going to be going over your trades, breaking them down step by step, and literally pointing out you guys where you went wrong, where you went right, what psychology and what emotions were you going through in that specific trade, and how we can level out those emotions to more of a neutral state. Because if you look at the main statistic of why people fail in the trading industry, it's not because they've got the technical side of things wrong, it's because they haven't yet mastered their psychology. So that's exactly what I go through with you in the one-to-one. We'll go through psychology work, strategy, refining your actual model, refining your risk management plan, and actually tailoring a full risk management and scaling blueprint for how you pass funded accounts, how you get payouts, and how you scale to upwards of 5 figures per month. So if you are serious and that is something that you genuinely are interested in, then the link is in the description. Just message me the word mentor on Instagram. I'll ask you just a couple of questions and I will see if you are the right fit for the one-to-one mentorship. Okay guys, that wraps it up for today's video. Now if you learned something new from this video, then please feel free to drop a like and subscribe. I'll see you guys all in the next one.